um, I want to make sure that we're conceptually understanding what's going on. Okay, what is happening at the end of a period? Um, the concept of retained earnings. What does that mean? When we have starting balance, we add the net income, we subtract the dividends, we get the ending balance. So I think I showed. I don't know if I did this before, but if it's a repeat, maybe now it'll make a little more sense. Okay, so I have on this spreadsheet just 5 years of like kind of hypothetical uh, income statement information for this company. Okay, and I also have the dividends. Now, if I just took since the beginning of time, and assuming this is like the whole history of the company, okay, this is year one when it first started, in the next 5 years. If we took all of the uh, net income, which is again is your revenues minus your expenses for each year, all of the dividends, I think we can all agree that this ending balance, $62, is the retained earnings, right? For the company as for its whole history. Do we agree with that? Okay. So again, presenting 2020 through 2025 income statement is not really the most useful. Most people are only going to care about what happened last year, right? We're only presenting 1 year financial statements usually for like public companies, okay? So we just actually are going to show in the most recent year, just this year five. Okay, so how do we get, because we need this $62 to make our balance sheet balance. That is the actual ending balance of retained earnings. Okay, so what we do every year, okay, in the first year, it's easy. Our retained earnings balance starts at zero because it's the first year of a company. We add the net income, we subtract the dividends. Okay, and now let's say this is 2020. Now reporting 2021, this retained earnings balance has changed, right? We could, again, do this where we add up both the years of net income minus, actually, hold on, let's do this, minus the total of the dividends. Okay, that's going to give us $50. The other way we could do it is just take ending balance from the previous year plus your net income minus your dividends of just this current year. And you get to the same amount. Okay, so that's what we're doing when we're updating retained earnings, because in order for the balance sheet for 2021, we needed this $50. That's going to be the balance on our balance sheet to make everything, to make the balance sheet correct. Okay, so now in year three, we can either do the same thing where we take the sum of all the whole history of the business minus the whole dividend history, and we'll get 37, or we can just take previous year's ending balance plus the net loss in this year. You can see it's a net loss, right? Our revenues were less than our expenses, and we subtract the dividend. Okay, and we get the same number. Okay, does this make sense to you guys? That this ending balance is the ending balance for retained earnings. You need it to complete your balance sheet. Okay, and that number is actually the whole history of the business, all of the net income less all of the dividends. And we need to keep updating it with whatever happened in our most current year. Okay, so that's what we're kind of doing in this closing process, where we're updating in our accounting system the retained earnings to whatever happened in that year, that accounting period, and making it the starting balance for the next period. Okay, so again, we could take the starting balance of year four is the ending balance of year three, plus what happened in year four in terms of net income and dividends, and that's going to update it. And then we just do this one more time, and you can see that we get to the exact same number as this. Okay, so this concept of beginning balance plus what happened in the uh, current period with net income minus what dividends were paid in the current period gives us the ending balance. This $62, which we get in both methods, encompasses all the previous history of the whole company, kind of reduced into one number. Okay, so look, This company has totally different revenues and expenses. The net income is the same. So let me zoom out a little bit. Okay, so different revenues, different expenses, but the net incomes are all the same. If I did the same calculation, I'm going to get to the same result as the above. Okay, $62. So this $62 is actually encompassing all the history, but we're losing information. From the $62, we can't go back and say what was the revenue from year two, right? So it's netting everything together, seeing what the net effect was, and carrying that forward. So there is some loss of information. It's not a totally lossless kind of summary, right? We can't go backwards and from $62 know all the details, but we know in summary what happened. Okay? Is that registering? Hopefully. If it's not, ask me now, because I'm assuming I've now explained it in a couple of different ways. You guys are seeing it up here. So if you don't understand, there's no dumb questions. Just make sure you ask now, because this is an important concept. Okay, so let me show it one other way. Okay, so in this accounting software, as I showed you, there is all the transactions are recorded here. Okay, just like how we've been doing in the homeworks, we have all those journal entries, right? For the whole period, we have a bunch of journal entries, and these are every time there's an entry here, it's changing some balance. So you can see this one is service revenue and cash, right? So my cash balance went up. I recorded a service revenue. So these are all different transactions. Okay, they get summarized in this trial balance. So this is as of the end of 2020. Okay, this is one day before actually the end, because I did. If I look back here, I'll show you. I have some adjusting entries. Okay, so if I filter this by journal, you can see here at the end of each of these 3 years, I did a journal entry for some adjustment, and it's for car insurance expense, right? So I prepaid at the beginning of the year, and at the end of the year, as you can see, they're all dated on the last day of each period. I did an adjusting entry to capture the expense, right? Because if I paid car insurance on January 1st, at the end of the year, I've used it up. So I need to expense it, right? So these are all dated as of December 31st. So if I look at the trial balance as of one day before the end of the year, you can see I have this prepaid insurance asset, right? Now, if I just go one day forward, that's going to go away. And you're going to see that I have this insurance expense, $1,200, because of that adjusting entry I did, right? So these software packages, they're actually there's a running balance. They're going to have the accounting records since the beginning of the company, right? So I can make my balance sheet for any day of the year, because it's going to know exactly what the cutoff is and then see what the balances are for all the accounts up to that date. So if I just pick some random day, it will update it, because again, it has all the transactions, and it's just adding just like I did here, right? It just adds up from the beginning of time up to a certain point and is seeing what the balance is. So again, with the software, you're never gonna have to do closing entries, because it's actually just doing this. It's just adding up from the beginning and seeing what the balances are. Okay. With the income statement, it's a little bit different, because it has to do it between 2 days. So let's see. So if I go to the income statement, I can specify this from any random period of time. Okay, I can do 2021, March 15th through 2022, I don't know, 26, okay? And it will just filter, right? Because it has all the transactions. It will only filter the revenues and expenses for this exact time period I'm specifying. Okay, so the software, again, I'm trying to emphasize this closing process that we're doing. You don't have to do it with the software because you're not updating a balance like retained earnings every year. Okay, because this thing just keeps a running balance of every single account that you have, and it can cut off things at whatever time periods you want. Okay, so though we're reporting typically from January 1st through December 31st or whatever, this thing you can specify it exactly because it has all the transactions. It can just filter exactly on the dates that you're or the period of time you're looking for and just look at those transactions. Okay, so the software is much more powerful. It's way more flexible than the way with the closing process you like kind of lose all the information from your revenue accounts. Because remember, when we do that closing process, we're zeroing out revenue, we're zeroing out the expenses, and so that information is kind of lost. Okay, but nothing gets lost in software. It's all recorded, and it all just you can filter it by your whatever specific needs you have. Okay, does that make sense? Yeah? Yeah. Yeah, it's called a Wave. It's free. I would just mess around with it, Like the way I set this up is I just went to Gemini and I said, "Hey, give me like 2 years of transactions so I could create a company in Wave," and it just gave me a bunch of transactions, and that's how I created it. So if you want to practice using the software, you can do it. That's how I created this company. I think it's called, if you just sort of Wave Accounting. This first one is a competitor called Zero. It's paid, but the second one, Wave Small Business Accounting, just click on that. You can just open an account for free. Okay. Okay. So any questions on this? So again, this whole chapter is a contrived thing. Okay, you're never gonna have to do it, but I think it is helping you understand this concept that I tried to illustrate here, where we have an ending balance for the end of a year that becomes the beginning balance of the next year, and then we're updating it based on what happened. Okay. Okay. So let's just practice doing another. Actually, I don't know if we finished. So let's finish this. I'll give you like a couple of minutes. Um, Make sure you have all four of these correctly. I think we did, I guess, three of them. So just finish this off, and then we're gonna do another one. Okay, I'll give you a fresh situation, and a company with totally different revenue expenses, and you'll have to do it again. Okay, just to make sure you're clear on this. So take, I don't know, like 5 minutes. There's only one left. Okay, so just take a couple minutes and finish it. So I put in the rest of these expenses. Does everyone agree with this? Am I doing this right? Any disagreements? Okay, so we can already see that our income summary has two entries, this credit from when we close revenue, and now we have this debit. So we can already see that income summary is going to have what? A credit or a debit balance? What do you think? Scott, did you have a uh this? I just made this up because from this 16,800, we don't know the details. We just know the balance, right? Yeah, so I was just putting in some hypothetical numbers. Yeah. Okay, so so income summary is gonna have a credit or debit balance. Obviously a credit balance. I have it right here. Okay. The credits exceed the debits. It has this $10,600 credit balance. Okay, so to close that, we need to debit income summary because again, income summary is a fake account. It's like a temporary account we're just using as a placeholder. So we want this to be zero. So I already have half my journal entry here, 10,600. And then what's my credit going to go to? If we look up here to our diagram, I just did this, debit to income summary. We see the credit goes to retained earnings. Okay, so this is part of that update for, we started with our, in this case, it looks like there's no beginning balance for retained earnings. So let's just make sure. See what's going on here. Okay, so now I have this credit. Oops. So I'll just have this. This is our beginning balance, okay? Just to be absolutely clear. There's a zero beginning balance. If there was a beginning balance, we would see it on this adjusted trial balance. It would say retained earnings, and it'd probably be a credit balance. If we've been making, if there was positive retained earnings. If our company had been generating a loss since its inception, or we've been paying out more dividends than we earned, it would be a debit balance. So retained earnings could theoretically be a debit balance, right? So for some startups that have no revenue, they're going to have a debit balance for retained earnings because they've just been generating losses every year. Okay, but we would see it. Okay, but since I'm looking on the trial balance, I don't see any retained earnings. So now we're going to debit it 10,600. Okay, and then the last step is to close dividends. Okay, so if I look here, I see that I have a debit balance in dividends of 800. So this was my ending balance. I'm going to close this out. I need to make it 0. So that means I need to credit it 800. Okay, so dividends will be a credit 800. And again, I can look on this diagram and I see credit dividends 800, debit retained earnings. Okay, so then I will put this $800 debit here. So now my retained earnings balance has been updated to reflect what happened in my company this period, in terms of now the revenues, expenses, and dividends have all been netted together to give me this, what is it, $9,800 ending balance. And so I didn't just delete revenues, expenses, and dividends. I just netted the debits and credits together and have summarized everything into one balance in retained earnings. Okay, so now it's going to continue living on. Next year, that $9,800, reflecting what happened in this period, is going to get updated with whatever happens in the next period. And then that will become the beginning balance of the next period, and it just keeps getting updated. Okay? Okay, so let's do another problem. I think, what number was it? 4-22. So there's another tab here. You can see, just a hint, there is a retained earnings balance here. Okay, so this is the case where you're going to have a beginning balance for retained earnings, and you're going to now update it with whatever happened in this period. Okay, so same thing. Okay, it's just a different company, different set of accounts, and so you can have 4 closing entries: closing revenues, number 1; closing all the expenses. You can see there's a bunch of different expense accounts here. You have to close each of them individually. Close dividends, and then close income summary, and then close dividends. Okay, so there's four different journal entries. Okay, so go ahead, try to see if you remember how to do this, and we'll do it again together in a little bit. Okay, if you're wrapping up, continue to wrap up. I'm just going to start doing it here. Okay, so step 1, close revenues, right? Because there's 3 temporary accounts, or 3 types: revenues, expenses, dividends. So the first step is to close revenues. So I see that my revenues are, as we expected, a credit balance, 94,000. So I need to debit service revenue, 94,000, to close it. And we're going to credit income summary. So service revenue, debit, income summary. Now income summary is just this contrived thing. We could get to the same answer by just crediting retained earnings. Okay, if we did that, the balance for retained earnings would still be correct. Because remember, the income summary, that balance is going to get moved to retained earnings in general, like at some point anyways. Okay, so income summary is just this like temporary account. I think it's cool to just show how you can use debits and credits in this system to like kind of move things around. But it's something that we're going to close, as we know, in the third step anyways. Okay, so that balance in income summary is going to move to retained earnings either way. But we'll just do it the textbook way. So we'll close revenue to income summary. We're going to close all the expense accounts to income summary. So we know that we're going to debit income summary. We don't know the total yet because we have to go through each of the expenses now and close them individually. So there's insurance expense, salaries, supplies expense, utilities expense. And then we have these two different depreciation expenses. We're going to have to close them individually, though they're both depreciation expense. You can see that they're two separate accounts because they're tracking the depreciation for the different types of assets separately. Okay, so in our accounting system, we don't just have one account for depreciation expense. We're differentiating it by the type of asset we're depreciating. So following the system, each of those individual account balances needs to go to zero. So we're going to put them as two different kind of entries into this accounting system. Oops. Okay, so I have all these numbers here, and I'm just going to fill in the numbers based on my trial balance. Okay, and then I can just use Excel's sum formula to add all these up. Okay, so I can see that I made a profit. I think there's one of these, I think maybe 4-20 that had a loss. So you're not going to see a loss. Maybe I'll just change the numbers a little bit in a second. But for now, you can see you made a profit. Your revenues were exceeding your expenses. And so income summary has a credit balance, right? The credit to income summary is more than the debit. And so we know that to close income summary, it's going to have to be a debit, and the amount is going to be this minus this. Okay, this is going to retained earnings. Okay, so just to be clear here, 94,000, 70,000 to 525. This is what was in income summary from the first two closing entries. This right here, credit 94,000, and this debit. And so if you calculate the balance, it's 23,475. Now to get this to go to zero, I need to debit 23,475. So that's what I did right here. I just kind of did it in one step. Okay? Any questions on this so far? We're good? Okay, so now income summary is zero. We've moved basically the net effect of revenues minus expenses into retained earnings. Okay, this 23,475 we would have seen on our financial statements. It would have been on the income statement, right? This is our net income, revenues minus expenses. Okay, but now it's a number that's actually reflected in our accounting system because remember, the financial statements are just reports. We're just calculating different things. We're tabulating our results. Now the accounting system has been updated. Okay, we've zeroed out the revenues, we've zeroed out the expenses, we've moved that balance, that the credits minus the debits, into retained earnings. Okay, and so the final step is to close dividends. So you can see the dividends. We paid $28,000 in dividends. So that's also interesting. Okay, we earned in profit $23,475, but we paid out $28,000. So we paid out in dividends more than our earnings from this year, which is totally possible, right? We have other retained earnings from previous years, and we just paid out a little more than we earned this year. But companies can do that if they choose to. Okay, so you're not like limited by how much you earned in net income in a period of how much. That doesn't limit how much dividends you can pay. You can actually have zero retained earnings and pay out a dividend. You can borrow money from a bank and just like pay that out to your shareholders. Okay, that's very frowned upon. The bank won't allow you to do that usually, but it's like possible. Yeah. Well, it's not a net loss because you made a profit, right? Your revenues did exceed your expenses, but what you've returned back to your shareholders is more than you made in profit that year. So that's not sustainable, you can argue. If you're giving back more to your shareholders than you're earning, at some point you're not going to be able to do that. Okay, so yeah, so I'll show you. We'll see what happened to retained earnings. But let's just close this out. So we're gonna debit retained earnings by 28,000. We're gonna credit dividends. Okay, so now all my temporary accounts are zeroed. Revenues, expenses, dividends are all zero, and retained earnings now has everything inside of it. Okay, so let's see what the balance of retained earnings is. Okay, so I look on my trial balance. I see that I have a starting balance, a credit balance of 30,325. Okay, so what happened here? Okay, so in this journal entry, I'm getting a credit 23,475. And then this one, I'm getting a debit 28,000. Okay, so now what is my balance? What is the ending balance here? If we do this, I will add up my credits, subtract my debits, and this is my ending balance. Okay, so you can see here, I had this like piggy bank of 30,325 from the existing periods. So even though I didn't earn enough in this period to pay those dividends, I had that piggy bank to rely on. So you can see that I still have a positive retained earnings balance. Make sense? Okay. Okay, any questions on this? No? Okay. So after we've done these closing entries, okay, we have this post-closing trial balance. It's just another trial balance with all the account balances. But now what balances are not going to be in here? What do these journal entries just accomplish? And dividends. So look on here. This post-closing trial balance. Look at the bottom of it. There's no revenues, expenses, dividends. It's all been closed out, and retained earnings has been updated. All those debit and credit balances for revenues, expenses, and dividends got collapsed down into either a debit balance or a credit balance, and then added onto retained earnings from the previous period. And that retained earnings, that is living on. Okay, so this retained earnings balance right here that includes all the revenues, expenses, and dividends from the period. It's all just been netted into that, just like we did here, right? This 25,800 includes the revenues, expenses, and dividends from the period. And that 25,800 is going to be on the post-closing trial balance. And that's going to be the starting balance for the next period. Make sense? Yeah? Okay. Again, all the accounts on the post-closing trial balance are permanent. These are all the starting balances for the next period. So your assets, your liabilities, and your equity accounts. And now your equity accounts are common stock. So your contributed capital and your retained earnings, those are, kind of permanent accounts that are now moving forward. And then your temporary accounts will restart. They'll start at zero. And then as you earn revenue, as you have expenses in the next period, those will repopulate. And in the next period, again, you'll condense them down and then put them into retained earnings and just keep that going forward. Okay? Make sense? And again, just to tie this back to our accounting cycle, in the first step here, we have starting balances. So again, retained earnings is a starting balance for the next period. And then you're going to have all your journal entries for the period, all your revenues, expenses, dividends, buying using cash to buy land, using cash to buy machinery. That's like two assets being traded for each other. You're going to have all that stuff going on in the period. It's going to change your balances again. You're going to do your adjusting entries. You're going to make your financial statements. You're going to update retained earnings like we did with these closing entries, and then all those will become the starting balances for the next period. You just keep this going. Okay? Okay, so I don't know, let's take like a couple minutes. I think we'll stop here. I have a little video, fun video, and we'll just have some stuff to wrap up here. Maybe we'll do one more of these closing entries just to, if we have time. So why don't we start back up at 143, 142. She need to go to the bathroom. Okay, so let's talk about this question. If a company cannot pay off its liabilities, what happens to it? Why does a company want to avoid this? Yeah, Mohammed, what do you think? Okay, yeah. So if you don't have the cash to pay for your liabilities, you'll have to start selling assets to raise the cash to do that. And maybe you don't want to sell your assets. Maybe, it's like a real estate slump and you'll have to sell your building and you don't want to do that. Okay, yeah. So that's definitely one possibility. Yeah. What's your name? Yeah. 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 If you can't pay off your liabilities, um, other lenders are not going to be willing to lend to you. Yeah, definitely. What about the worst case? What happens if you have more liabilities than assets than all your assets combined? What is that called? That state where, let's say all your assets combined, you have $100. Your liabilities are, let's say, 120. So even if you sold everything and made it cash, you still cannot pay off your liabilities. What is that called? Bankruptcy, okay? Actually, what you have here in this situation, how do you get the accounting equation to balance? What does equity have to be? Minus 20. You have negative net worth. The owners are past zero, okay? But really, the lowest you can go is zero, okay? So at this point, your lenders are going to take a loss, okay? The equity holders are wiped out. They're not going to get anything. And in fact, even the lenders are probably not going to recover all their money. Okay, so this is why you as a lender also have to be careful, right? You don't want to be in this position where you're taking a loss too. Okay, so seeing how indebted a company is, keeping track of that is important for both the owners and the lenders. Okay, these people both care about this. Okay, so this current ratio, it's a financial ratio that is trying to quantify this situation of how indebted a company is. Okay, so as we said, a company wants to avoid bankruptcy, right? Uh, and investors, both owners and lenders, they want to avoid a loss. Okay, so they're going to both care about how indebted the company is. Because really, like, I read a headline where there's like this prominent kind of financial commentator. He's saying that there's going to be a wave of bankruptcies in software, in software businesses. That it may be true that software businesses are going to become far less profitable, but if they haven't taken on any loans, then there's going to be no bankruptcy. Okay, because there's no one that has lent them money, or they have very little loans and they could easily pay it off before they're like their business totally disappears. They will just become bad businesses. Okay, they'll just be low returning for the investors. Okay, so the only way you can go into bankruptcy is if you have liabilities, if you have debts you cannot pay. If you just have equity financing, the owners are going to suffer because this business will just not earn as much. It will give them a low return. Okay, so so that's why we're again focused so much on liabilities, on borrowing. Okay, so if you don't pay off your liabilities, your vendors will stop supplying you with uh, goods and services. So, like if you have your janitor, and you stop paying them for there's 2 or 3 months of their kind of fees, and you haven't paid them, they'll just stop cleaning your place. And the same thing if you're an auto parts maker and you're ordering parts from a vendor and you stop paying them, at some point they're just going to cut you off. You won't be able to continue your business. Okay, so um, that's one. Default on your loans, so you go into bankruptcy. Your equity holders will typically get wiped out. If your employees are not paid at some point, they will stop working. There's a story of FedEx when they first started. Uh, the employees were so loyal to the business when it was a startup that there were some months, or I don't know, there's some period of time where they didn't have enough cash to meet payroll, but the pilots and all the workers were so loyal to the company, they worked through that period without pay. Okay, but that's because the culture of FedEx was like that. In the company, I think some pilots even like lent their own personal money to the business. Okay, so but in the typical case, unless you have like a crazy strong culture like that, the employees will just stop working if you stop paying them. Right, so that's a ramification, and of course the equity could get wiped out if you're too indebted. So the current ratio is an attempt to gauge this risk. Okay, you're going to focus on the liabilities that are most immediately coming due. So these are your current liabilities. These are the ones that are due in the short term. And so you're most concerned about meeting at least those, right? That's like kind of the minimum. You want to make sure your business is well equipped to meet your current liabilities. And so what you're trying to do is figuring out how much coverage you have those current liabilities with your current assets, meaning your most liquid assets. So it's basically a pretty simple ratio. You're taking your current assets divided by your current liabilities. So what's the intuition? Is it higher the better or lower the better? Higher, right? The more dollars you have in current assets to cover your liabilities, the better. So it's like, let's just put some numbers. If I had $300 of current assets and I had $100 of current liabilities, I have a 3x coverage. I have 3 times the amount of current assets I need to pay off my liabilities versus, let's just say I had only 120. Okay, that's lower. You still have enough current assets, but it's much lower. What if you only had 80 and you had 100? You only had $80 in current assets versus $100 in current liabilities. What is going to have to happen for you to meet those liabilities? There's a couple different scenarios that could take place. What do you think? How would you do it? Any ideas? Yeah, Andy. Yeah, yeah, you could sell some other non-current asset, right? To raise cash. Because cash is a current asset, but like machinery or like equipment, that's all like not current. So that's not included in this current assets, right? So you have to sell something that's not included in current assets. It will then turn into cash, which will then raise that ratio. Okay. It could also just be like you're just go out there and have your sales team generate revenue, right? If you go out there and make a bunch of sales, you're going to get more cash or more accounts receivable, more current assets will come in. Okay. So something will have to happen for you to meet your current liabilities if this ratio is under 1. Okay, it's kind of dire. Something you're going to have to figure something out because you don't even have enough to meet your current, or you could borrow, right? That's the other option. You take on more liabilities, you're going to get more cash. Okay, it's going to raise. You can borrow long term, right? You could take out a 30-year loan and get cash now, so you have a long term liability, but you have a current asset. Okay, so but you're gonna have to do something. If the ratio is under 1, something is gonna have to happen for you to meet those current liabilities. You'll have to figure out something. So obviously, the higher the ratio, the better. Okay, and it's usually useful to compare this ratio between like competitors or companies in the same industry because it probably ranges pretty widely within industries. Okay, so it's not. It could be universally useful to show like a company is really safe, but the most useful part of this ratio is comparing different companies in the same sector. Okay. Okay. So everyone understand the intuition here, why it's important to meet your current liabilities and why this ratio helps you answer that question. Yeah. Okay. So I have a video here. Um, it's about a hedge fund investor, Bill Ackman. He's going to talk about a investment he made where a company could not pay its current liabilities. Okay. It ran into this big problem where it had a bunch of long-term debt that was due within the year. And so it was current, right? It was long-term when they first borrowed for 7 years or whatever. But after 6 years, that loan becomes a current liability, right? Because it's due in the next year, right? So they could not pay off a bunch of liabilities that they had coming up. Um, But the situation was not dire because they still had more assets. So even though you had, let's say you had assets, let's say, okay, in this case, I'm giving you the real numbers. So you had assets, 30 billion, you had liabilities of 27.3 billion, and of that, 18 billion are coming due. Okay. And this company was a mall operator. So these assets are like real estate, which is illiquid, right? We talked about. So though they had enough assets to pay off those liabilities, it was during the 2008 like real estate crash. They could not get liquidity, right? They couldn't sell those assets, and the lenders were not kind of willing to extend the loans. So even though they weren't bankrupt, right? Because we talked about bankruptcy is when your assets are less than your liabilities, right? So they're not actually bankrupt. They're just running into a situation where they weren't liquid enough to pay the liabilities. So he made a very risky bet that the bankruptcy court is going to see it that way too. Okay, so um, let's watch this.
So this is where the magic happens, our family command center with the Skylight calendar. We can see our schedule for the week. I also have our meal plan. Plans for the week, and then even our
I read somewhere called arguably one of the best hedge fund trades of all time. So I guess it went from $60 million to over 3 billion.
It was a good one,
All right.
but it wasn't a trade. I wouldn't describe it as a trade. A trade is something you buy and you flip. This is something where we made the investment initially in November of 2008. And we still own a company we spun off of General Growth, and it's now 15 years later.
So can you describe what went into making that decision to actually increasing the value of the company?
Sure. So this was at the time of the financial crisis, circa November 2008. What real estate's always been a kind of sector that I've been interested in. I began my career in the real estate business, working for my dad, actually, arranging mortgages for real estate developers. So I have kind of deep ties and interest in the business. And General Growth was the second largest shopping mall company in the country. Simon Properties, many people have heard of. General Growth was number 2. They own some of the best malls in the country. And at that time, people thought of shopping malls as these non-disruptible things. Again, we talk about disruption. Malls have been disrupted in many ways. And General Growth stock, General Growth, the company, the CFO in particular, was very aggressive in the way that he borrowed money. And he borrowed money from a kind of Wall Street, not long-term mortgages, but generally relatively short-term mortgages. He was pretty aggressive. As the value went up, he would borrow more and more against the assets, and that helped the short-term results of the business. The problem was, during the financial crisis, the market for what's called CMBS, commercial mortgage-backed securities, basically shut. And the company, because its debt was relatively short-term, had a lot of big maturities coming up that they had no ability to refinance. And the market said, oh my God, the lenders are going to foreclose and the shareholders are going to get wiped. The company's going to go bankrupt. They're going to get wiped out. The stock went from $63 a share to 34 cents. So, and there was a family, the Bucksbaum family owned, I think, about 25% of the company. And they had a $5 billion of stock that was worth $25 million or something by the time we bought a stake in the business. And what interested me was, I thought the assets were worth substantially more than the liabilities. The company had $27 billion of debt and had $100 million value of the equity, down from like $20 billion. Okay. And one, that, sort of an interesting place to start with the stock down 99%. But the fundamental drivers of the mall business are occupancy. How occupied are the malls? Occupancy was up year on year between 07 and 08, interestingly. Net operating income, which is kind of a measure of cash flow from the malls, that was up year on year. So kind of the underlying fundamentals were doing fine. The only problem they had is they had billions of dollars of debt that they had to repay. They couldn't repay. And if you kind of examine the bankruptcy code, it's precisely designed for a situation like this, where it's kind of this resting place you can go to kind of restructure your business. Now, the problem was that every other company that had gone bankrupt, the shareholders got wiped out. And so the market's seeing every previous example, the shareholders get wiped out. The assumption is the stock's going to go to zero. But that's not what the bankruptcy code says. What the bankruptcy code says is that the value gets apportioned based on value. And if you could prove to a judge that there was the assets worth more than the liabilities, then the shareholders actually get to keep their investment in the company. And that was the bet we made. And so we stepped into the market and we bought 25% of the company in the open market we had to pay up. It started out at 34 cents. I think there were 300 million shares. So it was at $100 million value. By the time we were done, we paid $60 million for 25% of the business. So about $240 million for the equity of the company. And then we had to get on the board to convince the directors the right thing to do. And the board was in complete panic, didn't know what to do, spending a ton of money on advisors. And, I was a shareholder activist, 4 years into Pershing Square, and no one had any idea what we were doing. They thought we were crazy. Every day we'd go into the market and we'd buy this penny stock and we'd file what's called a 13D, every 1% increase in our stake. And people just thought we were crazy. We're buying stock in a company that's going to go bankrupt. Bill, you're going to lose all your money. Run. Okay. And I said, well, wait, bankruptcy code says that if there's more asset value than liabilities, we should be fine. And the key moment, if you're looking for fun moments, is there's a woman named Maddie Bucksbaum, who was from the Bucksbaum family. And her cousin, John, was chairman of the board, CEO of the company. And I said, as she calls me after we disclose our stake in the company, she's like, Billy Ackman, I'm really glad to see you here. And I met her I don't think it was a date, but I kind of met her in a social context when I was like 25 or something. And she said, look, I'm really glad to see you here. And if there's anything I can do to help you, call me. I said, sure. We kept trying to get on the board of the company. They wouldn't invite us on. Couldn't really run a proxy contest, not with a company going bankrupt. And their advisors actually were Goldman Sachs, and they're like, you don't want the fox in the henhouse.
Mhm.
And they were listening to their advisors. So I called.
So look, the book value, meaning the historical cost of these malls that the accounting books say, because remember, we have our principle of historical cost, right? Was around 30 billion. Okay, that's how much they paid for these malls. This is the accounting value of the assets. The liabilities coming due, I think they had 23 billion total, of which 18 are going to have to be paid off. Okay, but these malls are worth much more. Okay, because they probably bought them a long time ago. They have much more income now. So the stock market, what it's trying to do is figure out the true value of the real estate, right? Because the accounting value is not right. It's worth more than 30 million. Okay, so the market capitalization of a business is how much the stock market thinks that the equity is worth. Okay, so right now the equity is worth, if you assumed 30 billion is the value, it's worth 7 billion, right? Just to make it balance. This is called the book value of equity. The stock market value is going to be something much more, because let's say the actual value of the asset was 100 billion. Okay, the liability is a fixed amount. It's just a loan from a bank. What is the market value of the stock now? It's the same equation, but now we just have a different asset value, which is the true market value, not the historical cost. 23 minus 100. 77, right? So the book value is 7 billion. The stock market value of the stock might be 77 billion, right? Because it is trying to figure out this. It knows that this is what's on the balance sheet, but the stock market is people, investors, and they're smart enough to know that if they were to sell these malls, they're not going to get 30 billion. They're going to get much more than that because they're actually worth much more. So the stock market is trying to price the true value of the asset. Okay. So what happened to the stock is that it basically, and Bill Ackman is saying that the malls are still worth 100 billion. Okay, but the stock market value went from this, I think he said 23 million. Okay, so it's a penny stock now. Okay, it's to go from 70 billion market cap to 25 million. It's basically bankruptcy. Okay, it's gone to zero almost. Right? It's like 25 million as a fraction of this is such a small number. Okay, so that's what he's saying. The stock went down like 99%. Okay, so he's saying that actually there's still a ton of value because this is still worth 100 billion. The liabilities are still worth 23 billion because they're just like bonds basically. And so the company should be still worth around this much. And so he's making this bet that he can convince the judge that, hey, the assets are still worth a lot because the occupancy is still high, the income is still high, and the fundamentals of the malls are actually still really good. Okay, so actually there's still a ton of equity value in the business. And so if he's able to convince the bankruptcy judge of this, they'll kind of keep the loans the same, and this 25 million will go back to what it originally was, or somewhere around it. Okay, so that's the bet he's making. Okay, does everyone understand? Yeah.
How could it go back to the higher value? It's like if the price is too high, just market it.
People bidding it up, like the stock market right now, this is a publicly traded company, right? So just like a stock can go up and down in value, once it's kind of determined that this company is not going to go into bankruptcy and the assets are actually worth a lot, and the equity is not going to get wiped out. The stock market, the stock price will just go up, and it will get back to a price that implies this valuation.
And that just comes from the judge determining that it's not.
Yeah, and traditionally it would be like the lenders would take over the ownership of the asset, and that would wipe out the old original owners. So he's betting that no, the judge is not going to allow the lenders to just take ownership over, because the equity holders still have a value, like they still have equity in the property. So the ownership shouldn't just transfer, because that would deprive the equity holders of a largely valuable asset.
But according to their contracts, if they don't pay the liability accordingly, right?
Yeah.
The bank will, like the creditors will take.
So this is why it's risky, because you're right. Contractually speaking, you're correct. What Bill Ackman is going to have to do is tell the judge this is a once in a lifetime event, this crash of the financial markets, the real estate market, and therefore this is like there's certain clauses when like acts of God happen that kind of allow more leeway in the contract. So
He infused the company with cash. Why?
he's not giving the cash to the company. He's giving the cash to the former. It's just a trading of ownership. There's other owners that used to own the stock that Bill Ackman is buying their shares. He's not giving money to the company.
So he purchased from others.
Yes. Yes, correct. Okay, everyone caught up? Everyone good? Okay.
Maddie up. And I said, Maddie, I need to get on the board of the company to help. And she says, you know what? I will call my cousin and I'll get it done. Like, she calls back a few hours later. You'll be going on to the board. I don't know what she said to her cousin.
Well, she was convincing.
Next thing you know, I'm invited on the board of the company. And the board is talking about the old equity of General Growth. Old equity is what you talk about, the shareholders are getting wiped out. I said, no. This board represents the current equity of the company. And I'm a major shareholder. John's a major shareholder. There's plenty of asset value here. This company should be able to be restructured for the benefit of shareholders. And we led a restructuring for the benefit of shareholders. And it took, let's say, 8 months. And the company emerged from Chapter 11. We made an incremental investment into the company. And the shareholders kept the vast majority of their investment. All the creditors got their face amount of their investment, par plus accrued interest. And it was a great outcome. All the employees kept their jobs. The mall stayed open. There was no liquidation. The bankruptcy system worked the way it should. I was in court all the time. And the first meeting with the judge was like, look, this would never have happened were it not for a financial crisis. And once the judge said that, I knew we were going to be fine, because the company had really not done anything fundamentally wrong, maybe a little too aggressive in how they borrowed money. And stock went from 34 cents to $31 a share. And actually, fun little anecdote, we made a lot of people a lot of money who followed us into it. I got a lot of nice thank you notes, which you get on occasion in this business, believe it or not. And then one day I get a voicemail. This is when there was something called voicemail, probably a few years later. And it's a guy with a very thick Jamaican accent leaving a message for Bill Ackman. So, I return all my calls, call the guy back. He's like, "Hi, it's Bill Ackman. I'm just returning your call." He's like, "Oh, Mr. Ackman, thank you so much for calling me." I said, "Oh, how can I help?" He says, "I wanted to thank you." I said, "What do you mean?" He said, "I saw you on CNBC, a couple years ago, and you were talking about this General Growth and the stock." I said, "Where was the stock at the time?" He said, "It's 60 cents or something like this." And I bought a lot of stock. And I'm like, "Well, how much did you invest?" "Oh, I invest all of my money in the company." And he was a New York City taxi driver, and he invested like $50,000 or something like this at 60 cents a share. And he was still holding it. And he went into retirement, and he made, 50 times his money. And, those are the moments that you feel pretty good about investing.
What gave you confidence through that? Went to penny stock, and I'm sure you were getting a lot of naysayers and people saying that this is crazy.
It's the same thing. You just do the work. Like, we got a lot of pushback from our investors, actually, because we had never invested in a bankrupt company before. It's a field called distressed investing, and they're dedicated distressed investors, and we weren't considered one of them. So, Bill, what are you doing? You don't know anything about distressed investing. You don't know anything about bankruptcy investing. But I can read.
And you learned.
Imagine being able to build an app with your name on it just by thinking about it. Meet Base 44.
And I learned. And sometimes it's very helpful not to be a practitioner, an expert in something, because you get used to the conventional wisdom. And so we just, abstractly read the step back and look at the facts. And it was just a really interesting setup for one of the best investments we ever made.
How hard is it to learn some of the legal aspects of this? Like you mentioned, bankruptcy code. Like, I imagine it's very sort of dense language and dense ideas and the loopholes and all that kind of stuff. Like, if you're just stepping in and you've never done distressed investing, how hard is it to figure out?
It's not that hard. No, it's not that hard.
Okay.
I mean, I literally read a book on distressed investing.
Okay.
Ben Branch or something on distressed investing.
And so you were able to pick up the intuition from that, just all the basic skills involved, the basic facts to know, all that kind of stuff.
Most of the world's knowledge has already been written somewhere. You just got to read the right books. And also had great lawyers. Built up some great relationships. We work with Sullivan and Cromwell, and the lawyer there named Joe Schenker, who I met earlier in my career. Pershing Square is actually my second act in the hedge fund business. I started a fund called Gotham Partners when I was 26. One of my early investments was a company called Rockefeller Center Properties that was heading for bankruptcy. And the lawyer on the other side representing Goldman Sachs was a guy named Joe Schenker. So he was like an obvious phone call because it had yet another real estate bankruptcy. And that one, we did very well, but I missed the big opportunity. And I suffered severe psychological torture every time I walked by Rockefeller Center because we knew more about that property than anyone else, but I knew less about deal making and didn't have the resources. And I was 28 years old or 27. And they hired a better lawyer than we did. And they outsmarted us on that one in a way. So I said, okay, I'm going to go hire this guy the next time around. So.
All right. So,
Just wanna clarify.
Yeah.
They convince banks that the value is still in the company. So for 8 months, the banks not gather the interests.
yeah. So the banks did not agree to it. This is the court is the mediator, right? Yes. So this is all. Yes.
The
Right. So the federal bankruptcy court acts as like a referee. And because no one's going to agree to anything, so there has to be some neutral third party to like kind of adjudicate and force people to do things, because you're right, the lenders are not, they just want to get their money and take over and if they're opportunistic, they're like, well, the properties are actually worth a lot. I want to like just take them over and like, we'll have a very valuable asset. But they're not allowed to just do that. If the company chooses to go into bankruptcy to have this referee kind of decide how everything is going. Yeah. All right. Any other questions? I mean, he's kind of, I think, being a little hyperbolic that it's like easy to learn how to do like invest in a bankrupt company, but he's not entirely wrong either. I think now, especially with like the resources that we all have, you could learn a lot. And of course, like I think he's also underemphasizing how important it was to hire that bankruptcy attorney that he did, works at like one of these really big prestigious law firms. But you can learn the intuitions. I think that is right. But it's all built from this, right? Hopefully you heard this guy talking and using the language that we've been using in this class, right? So the point of what you're learning in this class is to be able to understand this language of business, because this is really how people think about investing and like corporate finance. All these things are using this language we're learning in this class. Okay, so the more you're gonna get deeper into this topic, you should be able to listen to this type of story and narrative, because he's using terminology not for like a totally lay audience. You kind of had to know something about finance and real estate to kind of get the full picture of what he was talking about. But I'm hoping that you guys are going to be able to be okay at it by the end of this class. You should know, when he says the asset value exceeds the value of the liabilities, you should know what that is conceptually. Your brain should have some model of that built in after this class. Okay, so okay, any last questions on that? No? Yeah.
What is the like 3 billion plan? What is the arrow to the right to 18 billion?
Oh, that's how much was due in the next year, right? So this has to do with this idea of current versus long term, right? If that 23 billion was due in 7 years, it's not a problem, right? Because they still generate so much cash flow from the business that they're doing okay. But the fact that so much of a lump sum is due at once, that's what caused the problem. Usually, and again, like he kind of mentioned this, when the financial markets were working correctly, it's like refinancing a loan, right? You have a bunch due, but then there's a new lender that's willing to lend to you. So you borrow new money to pay off the old, right? And it's kind of like it's like hot potato, right? But in 2008, that game of hot potato totally stopped. So this 18 billion that they could have easily refinanced a couple years before with a new bond issuance, since that market was totally shut down during this period, they could not find someone to throw the hot potato to. Make sense? Okay. Okay. So the last topic here, and I think I mentioned this, reversing entries. Okay, this is like definitely something you can see if you work as a like an accountant, or like if you work even with your own small business. The accounting software that we just saw, if you're using that, this would probably be the easiest way to manage your adjusting entries and your accrual accounting. Okay, so what it is, okay, it's kind of a trick. Okay, what you do is you're gonna make your journal entries at the end of the period for your adjusting entries as normal, and it would happen on December 31st. We know that our adjusting entries happen on December 31st. And so when you had a cutoff date, we saw with that accounting software, you can move one day at a time and create a balance sheet for every single day, right? But usually our financial reporting happens at the end of each period. So December 31st is an important day and an important cutoff, because that's when we're going to make our financial statements. So our adjusting entries will be dated as of the last day of that period. Okay. So what you'll do is you'll do your adjusting entries, and then on January 1st, the very next day in the new period, you reverse some of them. Okay. And which ones you adjust or reverse, we'll talk about. Okay. So, and we'll see why this makes the accounting easier. Okay. So, this trick only applies to accruals, not deferrals. So what are accruals? What's the difference? Does anyone remember?
You are not paid, I mean, cash after
cash after, okay? So this will be for things like interest, right? Where we had interest expense was our debit, and our credit was like interest payable, right? Interest payable. In this case, the interest is getting paid after with cash, right? And we're just first recognizing it, okay? Or it could be service revenue, accounts receivable, right? Anything where the cash is going to come afterwards, we're only going to be able to use this trick of reversing entries for those, okay? Not for like deferrals where we had like prepaid insurance at the beginning of the year where the cash was already transacted, and then we're doing an adjusting entry to adjust for an expense, or like depreciation. These are all deferrals, right? So again, just to be clear, this trick is only applicable to accruals, okay? Now, I think it's easiest to show this with an example, okay? So on December 31st, we're going to make an adjusting entry for $1,400 for payroll, okay? So I think we should all be familiar with this type of entry. After this adjusting entry, these are our balances as of December 31st, okay? So we have correctly the salary expense, and we have this liability, this salary is payable. Okay, so now our December 31st cutoff date, our financial statements will be totally correct, right? We have all the correct expenses. We're showing that this payable exists to our workers. And so our balance sheet is going to be correct. It's going to correctly show our liabilities and our expenses. Now the next day moves forward, okay? And so let's do two different scenarios, okay? This side is without doing any reversing entries, and this is with, okay? So without the reversing entry, when we actually make the payroll, okay, half of this, so 1,200 is for the previous period, and 1,200 is for the current period, right? What is it? 1,400. Shoot. So this should be 2,800. Sorry, I got to change that. Okay, so So without the reversing entry, we're going to have this situation here. And I think we kind of saw it where we're going to have half of it be an expense. And again, this is January of the next year. So half of it will be an expense for that period. Half of it will be for that payable to pay it off. And we're going to pay out the full 2,800. Agreed? Everyone good with that? Okay, so then we're going to correctly have 1,400 here. We're going to have 1,400 here. So this goes to 0. And we correctly have the expenses for this period. So this is a totally legitimate way to do it. But we kind of had to remember this, right? We had to remember that we had that payable. Okay? So now let's do it with the adjusting entry. Okay? So as I said, with adjusting entries, the trick is on the very first day of the next period, we just reverse out this situation here. We just undo it. Okay? So what's going to happen? We're going to have 1,400 here. A debit to a liability. This is like something weird, okay? And we have a credit to an expense. So there is something a little off here, but it's okay. It's going to work out. We'll see this in a second. So after this reversing entry on January 1st, we're going to have this weird situation where we have $1,400 credit balance in expense, right? So we agree this is wrong, right? I mean, it's not following our standard model because expense accounts are debit normal, right? So to credit a expense account is like kind of weird, right? But we'll see how this is going to work out. And we already just clear this out. We just pay this off. So now we don't have to worry about this liability at all. It's gone. Okay? So now on January 15th, when we make the payment, we can just attribute all of it to this period. We don't have to remember that we had that payable. So we'll just do 2,800. 2,800. And so now when I do this, what's my balance? $1,400 debit, right? So now we have the exact same situation as here. We have $1,400 debit, and we already zeroed this out. So the payable is 0. Okay. The benefit of the reversing entry, again, doing this just on the first day of the period, is you do not have to remember about any of those accruals. You can just treat every cash transaction that happens after as if it's fully for that period. Okay, so there's less kind of having to go back and see what you did in the last period. You just treat everything, again, see, I mean, we just treated this entire payday as being in this period. And it worked out because we did that reversing entry here. Okay? So this only, again, it only works for accruals. This would not work for prepaid, depreciation. We're just doing this for when the cash is transacted after the adjusting entry. Okay? Yeah. Yeah, it's again, in the accounting system, there are no such things as temporary and permanent, right? In this software I was showing you, everything is permanent account. You will just set your income statement to January 1 through December 31, right? You'll set the time period that will kind of create temporary and permanent accounts, right? But on January 31st, if this was your income statement, it would still have this as your salary expense kind of starting, so it will still work. It will still work even if you're not doing like closing entries. It will still work in that software system, because again, it's still just looking at the dates of your cutoff, right? So this is January 1st, so it will be included if you did this as your period for your income statement.
Just trying to figure out to which accounts this can apply.
Okay, so let's try this. Let's say on December 31st, you let me write this out so it's not so messy. Let's say you had to accrue, you have interest, okay, interest expense. And let's say you took out a loan. So you took a loan out on, I don't know, let's say July 1st. It is for $15,000, 7% interest, and principal and interest are due in 1 year. Okay, so let's just do an example here. Okay, we have time, so I think it's worth you guys understanding this and doing it yourself. So okay, so the first question is, what is the adjusting entry on December 31st? Okay, so this is question 1. Number 2, what is the reversing entry and the balances of interest expense and interest payable on January 1st? And then 3, on July 1st of the next year, what is the journal entry? Okay, so try this. See if you can figure it out, and then I'll give you 5 minutes because we're running out of time, and then I'll just do it in the last 5 minutes. So see if you can work with this. Okay, so the adjusting entry. Okay, so the math behind this, just to be clear, it's $15,000. Okay, my interest rate is 7%. Okay, so my yearly interest is $1,050. and I counted the months for you. It's 6 months out of 12. So for half the year, I'm gonna have to accrue half of this, 50% of this, so $525. That's the expense, the interest expense that I've gone from July 1st through December 31st. Do we agree? Okay, good. So I'm going to do interest expense. $525. And then I'm going to have a credit. What's my credit account? Interest payable. Exactly. Okay, and this is going to be on what date? What is the date of an adjusting entry? December 31st. Okay, so now this is answer number one. Okay. Now the second question is asking, okay, so now cutoff period happens. My income statement and my balance sheet for this year are going to be correct because they include this expense, includes this liability. Now moving on to the next period, I'm going to reverse this out. Okay, so January 1, the next period, I'm in a totally new period of time. I'm going to, kind of my expense accounts are going to start over technically, but they're not really like in an accounting software. I'm just have a new cutoff date on January 1st. So what I'll do is just literally reverse this, okay? I'm going to take the exact same accounts, but just undo them, okay? And what that's going to do is now, oops, my interest expense, that's going to have 525 here. And then my interest payable, it had 525. It got debited 525. It's now zeroed out. Okay. So I again have this weird thing going on here, but it's gonna get fixed when I pay off the loan. Okay. So now on July 1st of the next year, so July 1 next year, okay, I'm gonna have a couple of different accounts. I'm gonna have number one, I'm gonna pay off that note payable. Okay, I'm gonna debit that. How much? What was the how much did I borrow? 15,000. Okay, so I'm gonna debit that 15,000. Okay, and this is kind of the beauty of this whole system. I can just put everything, all the interest to interest expense. I don't have to worry about that adjusting entry I did before because I've already reversed it out. So what was the total interest? I think 1,050. Is that right? And then cash. Oops. $16,050. Okay. And so now, after I do this, okay, what happens is I have interest expense. It was 525 here, right? From this reverse, this 525. Okay, so now this period is going to show the correct amount of interest for that period of interest expense, even though in this journal entry, I just put all of it because I did that reversing entry. Okay, so it's quite a smart system. Whatever smart accountant or bookkeeper came up with this, it's quite brilliant. Okay, so that's why accountants use it. Because that's a deferral. This only works when the cash is transacted after. Depreciation is a deferral. Was that? Yes, but depreciation is when you buy the machine first, the cash transacts. Yeah, yeah.